Well, good morning, ladies and gentlemen of YouTube or Facebook or wherever you are. This is Adam with The Highest Return. You can find me on the Highest Return group if you just search it. You can also subscribe to my blog at thehighestreturn.com. If you're wondering why my face is so small up here in the corner, it's because I've got a lot of detail to go through with you guys. And it's going to take up most of this space. Now, today I'm going to talk about covered call options. I'm going to go over examples in Robinhood and Schwab. I'm going to go over some more detailed explanation of covered call options for the people who have patience to actually go through that. And then the very last thing I'm going to do is go over some of my trades to show you how I might have made money or lost money doing some covered call options. Now let's just go through Robinhood. I'll explain what I'm doing here. So this is the Robinhood app. How do you trade options? Well, first you have to be approved for options trading, and so if you've already done that, I'm going to give you an example of writing covered call options for Apple. Now, Apple is currently trading at $172 per share. It's a really good performer in the past few months as people have been moving over to value stocks, but it has had a little dip recently, which actually worked out pretty well for me because I did have some covered call options on Apple. So now, first thing you're going to do is you're going to pick a maturity date. Maturity date is when this option has to be exercised by. I'll get into those details later as well. Now, these prices that you see here correspond to different prices that you can say you're going to invest on that maturity date. So right here, $170, that's $2 less than the current trading price, but the premium is pretty good in these options. So if you sell these options, you're going to get $710 total. Now, what does the option represent? So the option has to be tied to 100 underlying shares of Apple, meaning in order to do this covered call, you're going to have 100 shares of Apple in your account, and then you can actually write a covered call option by doing what I just did in the screenshot. Now, it's not free money. It has its own risks, and those risks are part of, number one, having to hold Apple until the maturity date, and number two, Apple might go up a lot further than 172 that it's at right now. So as it is currently, if Apple price doesn't change, it stays at $172, then all you get out of writing this option is $510 or so. Now, let me show you how to do that with Schwab. So you go into your trade menu, go to your options tab, go to your symbol, and find the date, and I'm just going to go to the same date. That's February 4th. You'll notice that all options expire on Fridays, the weekend. Alright, so sell to open one, and then do my market order of $7.10. Click on review order. It'll tell you what you're going to make. Schwab does charge a small fee for option trades. It's less than $1, pretty much negligible, and I prefer Schwab over Robinhood myself. And now let's just talk about a few of these things here. So it says order verified using quote 6.8 bid. And what does that mean? So there's already a person out there that's willing to pay to buy this for $6.80. But you don't want to just sell it for $6.80. It's worth more than that. So what I usually do is I put a market order in for maybe 5 to 10 cents less than the asking price. And so what the asking price is, that is the lowest price that someone is already willing to sell it for. So nobody's actually bought it for that price yet, but they could. If you think that the price is going to go up throughout the day, you don't really have time to watch it, you can just put a limit order in for higher than the asking price for the option, and then it will probably execute. And don't be confused with the bid and ask price of Apple itself on the top there. That's the bid and ask price for the shares of Apple, not the options. Let me just go back here, and should be okay. So these are the bid and ask price for the options themselves, 680 and 720. Now I'm a little bit interested, and this is something you should be interested in doing too, comparing Schwab versus Robinhood, the bid and asking prices, because they may not actually be the same. So we go back to where we were trading the option. Yes. So the 170, it says $7. So Robinhood is doing a little bit of trickery here. They're basically by default saying that you can sell for $7 because they think, they're pretty sure that will go through. But that's not the bid price. That is just some number that they come up with. Let's go in. So when I clicked on that, 7. See, the bid is still 680, but they're saying to, by default, do a limit price of 7, which doesn't really get you the most money. So, be careful when you're trading on Robinhood. Try to learn more about limit orders, and you don't have to use that 7. You can do 7.10 to make some more money on this. And if you're doing this a lot, it can make a lot of difference in how much money you actually make. Sorry, that was just a little tangent there, but I think it's important. All right, so now that we've gone over how to do it in both Robinhood and Schwab, I'd like to talk about, let's talk about some textbook knowledge over this. Now, earlier I said you had to have buckets of 100 shares, underlying shares, to write covered call options. Let's talk about these numbers, what they mean. So this is a graph, and from left to right it represents share price, and from bottom to top it represents profit. When you first write this option, you immediately make some profit. So just understand that. Like when you're writing a covered call option, you're making some money because you're putting your shares on the line for a certain duration and you're getting paid to do that. If you're not getting any profit, don't write these call options. Make sure you have a healthy premium before you do this. Now the premium line here, that you see this, in the case that we were talking earlier, the premium was $710. Now, my example, I was trading Apple. Apple was actually currently trading at $172, and I was writing the covered call options for $170. I would only do that if I expected Apple to have a little dip, and then just to capitalize on that. But if the price actually remained constant, then the total profit that I would make, if I considered both the option and the shares, would be around 500 something. But if you're taking the option as a separate entity, that's what this represents, and the profit from that would be $710. Now, likewise, if the price goes up, the price of Apple goes up, and so that in this case, if it goes up, so we were doing 700, it represents buckets of 100. So if it goes up $7, then you start to lose money. So if Apple went up to 170, so it was at 172, so if it goes up to 179, then I shouldn't have wrote that option. Because at that point, if I just held the shares without writing the covered call option, I'd make more money. Because what this covered call option forces you to do is sell your shares at the strike price on the maturity date. So I'd be forced to sell 100 Apple shares for at $170 each on February 4th. That's what that represented. So you can see, technically, they say that these short calls have unlimited loss potential, but because you're holding the underlying shares, you don't have unlimited loss potential because the shares themselves will go up while the value of your options goes down. So that's why you have to do covered call options. You cannot just write short calls without having the underlying shares. That is how you get into the situations that we saw where somebody lost, $800,000 by only investing $10,000. Like, that's possible if you're allowed to do that. And I don't believe Robinhood lets you do that. It's possible that Schwab lets you do that, but you have to be on the most advanced level of options trading to be able to do something like that. To think of it in a more simple way, it's kind of like shorting stocks without buying call options. So that means I buy negative 100 shares, for example, of a stock. That stock could double, triple, quadruple in value, and that means that I'm losing more money than I could have possibly made. And technically, it's called unlimited loss potential. So you want to make sure you're never in that situation. So follow my highest return group on Facebook. I also have a Charles Schwab investors traders group on Facebook as well. And then we field some questions there. If you're ever wondering about if you're going to get in a situation of unlimited loss potential, you can certainly ask that question there. This presentation is not saying to write covered call options. It's just to teach what they are. Now, I'm going to go over some of my examples. All right, examples of my covered call plays. Now, this one's just a very simple one. I wanted to start with simple. So this is for Apple, and I actually wrote this back in December. And it was a wild ride because Apple shares went up to like 180, and my option went down in value to negative thousands. But in just the past few weeks, there was a stock market correction, and Apple went back down to a point where I could buy these call options back while making a very small profit. And now this, if I knew this was going to happen, I wouldn't have done it. I would have waited until Apple was $180 per share and then wrote some call options to make even more money. But here's just an example of one of the covered call plays, and I only made $128 on this one. All right, now this next one here is for Alpersons. I did make actually quite a bit of money on covered call options for Alpersons in this time period. It looks like $1,136. So the first thing I did here, if we go back chronologically, so I wrote 5 call options, strike price $30, expiration November 19th, 2021. And so the price for that, the premium, was $1 per share. And so the fees, it looks like the fees scale based on how much you trade. So it was actually $3.30 to do this transaction. So my premium for that whole bucket was $496. And then I bought 4 of them back when the price dipped of Alpersons. And that only cost me $202 to buy 4 of those back. So I still had 1 covered call. Maybe I needed the cash. And then later on, it looks like I actually just ended up selling that one as well for another buying that back for another $50. So $500, $250. That means basically I made $250 from these 4 transactions here, 3 transactions. And then this last thing here. Okay, so this one was actually assigned. So that means when it's assigned, that means you have to sell your shares for the price. So I had wrote the options for a strike price of $30, expiring, this is the November 19th again, and I made $900 off of writing those shares, but I didn't buy those back, and so by the time November 19th rolled around, Alpersons was trading more than $30 per share, and I was forced to sell my shares for that price, but I kept the premium. So what does that mean? That means it's like effectively me selling it for $30.90. It's not too fancy. And for this particular one, I believe it would have been better if I didn't write the call options. But, if you start to get in the habit of like doing this and making money and not losing money on it, I think it's a net positive. All right. Let's see. Oh, right. So most recently, might as well show you what I did most recently is I wrote covered call options for Walmart and Apple again. So this Apple one expires February 4th, and for a strike price of $175, and I made $4.45 per share on it. So meaning if Apple doesn't go above 179.45, then it's a good play. Otherwise, I probably shouldn't have done it, unless I was looking to sell the shares anyways. And this last one is Walmart, expiration January 14th for $145, and made $128 on that premium. Well, I hope you enjoyed this video. That's all I had for you guys today. Please comment below and just help support my channel. I've recently made some big life changes, and I'm hoping that I can be more dependent on my investing and videos. So have a great one, guys. Take care.